Hey everyone, thank you so much for joining us. I'm Jen and welcome to another episode of Blockchain Banter Trading Crypto. We've got Keith Allen here with us, trader and co-founder of Material Indicators, along with Crypto Corio, data scientist and narratives trader. Tyler, who was also our DJ. Thank you, Tyler. He's a DeFi farmer, trader, and like I said, our DJ. And Dr. Mark Richardson, project lead at Bancor and CarbonDeFi, an on-chain automated trading protocol. Thank you guys so much for joining us. Great to have you back. Keith.
Thank you, Jen. We're happy to be here.
Keith, I was going to pin your recent thread and kind of update, addition to it this morning. I thought maybe you can give us a little insight what your thoughts are, what you're seeing there on the material indicator side with your fire charts and signals and all.
Okay. Are you talking about yesterday's thread?
Yes, sir.
Okay. So let me just drop a note in the community and let them know we're getting this thing started. And let's see. Past couple of days, I noticed something, and this starts on the technical analysis side. And we discussed this, I think, maybe in last week's episode, maybe it was a week before. I don't remember. My life is bleeding together right now. But regardless of what tools, data, or indicators you use, I think it's important to always put things in context and use multiple sources, right? Don't rely on one thing because, it's just risky. Sometimes the indicators are off, or sometimes the market's doing something funky. So it's always good to layer multiple sources together and try and build context and build your story to help you arrive at whatever your opinion is. So in the past few days, I noticed something that I haven't really noticed before, and that was and not to say that it hasn't happened before, but it's certainly something rare because I just don't recall seeing it. And that is the 21 week moving average and the 21 month moving average were almost identical. They were like $18 apart at when I first started this, climbing into this, and that's something that's not normal. After discussing it in our Telegram community, one of our community members, and this is something I really love about having communities like this, is that there's always somebody who's got some insight that maybe you don't have. Great thing about this panel as well. And one of the guys in our community had chimed in and said, yeah, I've actually been tracking moving averages and I have a spreadsheet, and this has actually happened 4 other times since 2014. And in most cases it had led to a crash, but there was one instance where it led to a dump followed by a bull market, and that was what kicked off the 2017 bull run to 20K. So there wasn't enough data or enough conclusive to say that, hey, this is exactly what's going to happen. But really, it came clear that this is an inflection point. And on top of that, looking at the chart, we could see that we have just price jammed into this range between the moving averages and the structure. And as I said in the thread, lines on charts are subjective, mine included, right? But the moving averages are pretty solid. And so when they're not subjective anyways. So when your lines on charts correlate tightly with the other indicators that you're using, that's obviously a good thing. You then have confluence, and then you're on the road to building better assumptions. So on my chart, I can see that the moving averages, the 21 is what I was looking at in particular. the 21-week moving average, which has been support for, support that's been retested for the past 2 weeks, including this one, and my trend line are pretty much right overlapping. And then I have another channel that's the top of the range, which has been 31.8 as our local high, I think. So, basically around 31.5 actually is where I'm drawing this, where we've had a lot of resistance in the past since June. And the bottom side, which is around 28.5. So the 21 week and the 21 month moving average are hovering in that 28.5 range, right on top of the trend line. And I started seeing on fire charts, and this is where it came together for me, right? So, when you're approaching these structures or these technical indicators that you think, that you have, clearly showing a well-defined support level, anytime you're approaching that support level, you're testing, right? We're going to test support, and you have two options: you fall through it, or you bounce from it. And by looking at fire charts, we had chopped sideways through the weekend. We hardly moved at all. By looking at fire charts, I had we could see that support was building in that 28.5 range, and we also had a new signal on our trend precognition indicator, giving us a long signal on the opening of the candle. Now that's a tentative signal, and it won't print technically until the candle closes at the end of the week. But it was strong enough with all of the other factors that I saw. We're bouncing from this level. Support seems to be holding. We're seeing more bid liquidity come in, not a lot, but some coming in to the buy range. And so I felt that we would at least test support, and most likely higher probability of a bounce from there. Now, I don't want to give anybody the impression that I get it right all the time. My overall analysis was correct so far, but I got front ran by $78 yesterday. And what happened, and I could see this on the chart, and I actually posted it today, and I marked up a chart that you will see on the material indicators page, Jen. I could see where there was a bid ladder of about $20 million of bid liquidity. And this was, let me look and see where it is on the chart. This was in the 28,250 to 28,500 range. And that bid ladder disappeared yesterday, like right at the time of the bounce. And normally when we see liquidity pulled like this, we can see where it goes. Sometimes it gets rugged completely, but usually it moves, and we can see where it moves. In this case, I could see it didn't move anywhere. So I then started tallying up what the value of that bid ladder was, and it was 20 million. And then I looked at the value of the initial move right at that point, and it was 20 million. So that bid ladder turned into market orders, and that's what sparked the rally, to begin. And then they, of course, continued to pour money on it. As of this morning, about a total of 50 million just from that purple whale class. For anybody who doesn't know what I'm talking about when I say purple whale class, on fire charts, which is our thermal map of the order book, we have a binned CVD chart at the bottom of it, which shows you what each order class is doing by order size, and it ranges from small orders, $100 to $1,000 orders, all the way up to what we call mega whale, $1 million to $10 million orders. The purple whales, those orders are 100 grand to $1 million in size. They're all market orders, 100K to $1 million in size, and that class has historically dominated Bitcoin price action. So that's kind of, that's the one that I watched the most intently to see, the market's moving or what I anticipate a move doing. And yes, they buy dips and sell rips and scalp just like everybody else does. But when you zoom out to a macro level, you'll see how they influence the overall. But yeah, that was my whole summary on what I saw. So because I got front ran, because they made that market move, I didn't get the entry that I was hoping for, but I did get an entry, and as a scalp, and I'll continue to treat it as a scalp until I see a confirmation that we're really making a breakout to what appears to be a bull market. And I still have macroeconomic concerns that make me wonder if we're going to get that breakout. So until we do, these are still bear market rallies to me until I get that validation that we have a breakout, and then I'll move more towards accumulation strategy than I am in a trading strategy.
Very interesting, Keith. By the way, I have a question for you because we had a discussion last week, and I remember you said that your system is printing a bearish candle on the monthly, and now maybe a bullish candle on lower time frames. And this is actually something that I myself struggled with for a while when I was starting and developing my own strategies, because you have a strategy which is looking for a certain trigger, and this trigger on different time frames can be different. So you can have, for example, a bearish print on the monthly candle, and then all of a sudden a bullish print on the daily candle or something like this. What's your strategy about that? And are you focusing more on some time frames that is your preference and then ignoring the other ones? How do you take that?
You're absolutely right. Time frames are critical to whatever your strategy is, right? We were having this discussion in our Telegram channel as well today, right? You could be bullish or bearish depending on your time frame and be accurate, right? I mean, if you zoomed out to the forever lifetime chart of Bitcoin, you'd say, well, I'm bullish, right? because of in its lifetime, it's appreciated and has continued. But as we zoom into a little bit more, I mean, tighten into a little bit more realistic time frame, then we have to evaluate what we're doing based on the strategy that we're doing and the time horizon we have for that strategy. So I look at everything as kind of just like you look at an intraday candle as a micro of what's happening on the daily. For guys who trade really low time frames and scalp like that, I treat daily and weekly. I treat daily as an intra of weekly, and I treat weekly as an intra of monthly. Okay, so if I go for a scalp and it doesn't go directly the way I want it to, but I have an indication that that my weekly is still going up, or that my monthly, depending on what I'm doing, then I'll that will weigh in my decision of how I want to treat the trade. If everything looks down, that's a different story. But it's not surprising, if it was that easy, if everything was always the same direction all the time, it'd be easy. It's not, right? So the intras are often different than the macro view. So I do consider those in what I'm doing. When I scalp, I'm doing that obviously on a lower time frame. So I look for my setups. I look to see that I have momentum building, and I'll buy those dips based on my technical analysis and where I see the liquidity in fire charts.
Yeah, very interesting. I remember it was, I think, a few months ago that people were saying on Twitter, everybody was saying, yeah, we have a death cross on the monthly candle on Bitcoin, and so because there is a lot of people either trading or using that as a part of their strategy. You know, this golden cross, moving averages, that cross, the 50th and the 200, and usually, actually, when you look at the data, usually when you have a monthly candle, the death cross on the monthly candle, usually, if you look at historically, this is a very close to the bottom, because it means that the price has retraced so much that, you know, we are having this, and because moving averages or lagging indicators, you know, the price has depreciated so much that now we are having a death cross, but then this is not bearish, it's bullish, at least based on history. So that's also very interesting to see how different strategies and you know, indicators play out on different time frames.
Yeah, so I mean, just because at the moment we're in a rally or a pump, I don't know if it qualifies as a rally yet. It hasn't done a whole lot, but you know, after what we've been looking at for the past month of chopping, anything over a few $100 is like, seems like, you know, a big day. That hasn't changed my longer term view, right? I still, as I mentioned, still have macroeconomic concerns, you know, fundamental concerns that that there could be a major pullback. But I'm not smart enough to know if that's going to happen or not. So I let the chart tell me if it's going to happen. If it breaks through what I consider to be the support levels, then or if it breaks through the resistance levels, then I'll let that make my, you know, guide my decision. But in the range that we're in right now, I'm trading it as a trader rather than an investor.
Corio, I have a question for you. Keith, so, thank you so much, by the way. I did connect at the top. I believe I pinned everything at the top that you were referencing. So if there is something that I missed, feel free to pin it up there also.
Okay.
And before we all, you were speaking to your Telegram. If that is in fact a public Telegram that anybody can join, I would love for you to share that for our listeners as well. If they're not already in there, please let them know how they can actually become part of your community.
Oh, it is. There's a free community that is, there's a link to it in Twitter profile and on the website.
Perfect. Awesome. Okay. So for the listeners here, material indicators profile, you can find the link to the Telegram. Corio, I have a quick question for you. I definitely want to get into the new dashboard that you created. Before we do, though, we're talking about, you know, bull market, bear market. I'm kind of curious. You see that narrative build. Somebody posts a chart and it was like what Keith was saying. You don't just go by one resource, right? You kind of learn to do this yourself, see where you can kind of confirm these sorts of things. But do you find that when this sort of narrative starts building on bull or bear, we talked about time frame, but do you feel that it affects narratives trading that much?
Yeah, so yeah, I do think that cycles and the bull bear are very important, because when there is a bull market or a bullish sentiment, there is more liquidity, there is more risk appetite, and this changes a bit the dynamics of narratives and how the rotation happens. And also in the bull market, usually is not just one narrative that it's outperforming. You see a lot of narratives playing out, and so it's much easier to rotate, and you can have a higher win rate. Whereas in a bear market, if you look at the last 10 months, for example, it was, and by the way, we discussed about it last week, and I shared a thread about the 10 dominant narratives of the last year. It has never happened that you had more than one narrative playing out at the same time. So you had one narrative, for example, when ChatGPT came, we had the AI narrative that was dominant, and then that lasted for around 1 or 2 months, and then afterwards we had the LST narrative, and after that we had the meme narrative, etc. But it was always just one narrative outperforming. And so this makes it very hard as a trader, because there are around now on my dashboard, it's I have listed 30 narratives. And so when you have just one of them that is outperforming, is not very easy to know which one, and etc. And when does it stop, when does it start. But in the bull market, usually the narratives that have fundamentals, many of them have, they all start to perform well, because they have built during the bear market, and now they are getting more users, more liquidity is coming, and so and we have seen that also in the 2021 bull market. You had, for example, the layer ones was very, very strong, but it wasn't the only one. You had also other narratives like Dexes, etc., which everything was going up, but some narratives were doing better. So yes, the short answer is, in a bull market, it's multiple narratives at the same time that are doing pretty well and outperforming the market. And in a bear market, you rarely have more than one, and it's also shorter. So recently, the most recent probably narrative that that I would call narrative was the Telegram bots, and I wouldn't say it's still finished, but yeah, these narratives are lasting less and less, shorter, and they are shorter and shorter. So the meme narrative was maybe 5 weeks, and then this Telegram narrative lasted maybe 3-4 weeks, and so yes, it's pretty different and it really depends on the market cycles. And I think this is also valid for not just narrative trading, but any other thing that you do. Either if it's a TA or any fundamental analysis, or I think anything that you do in crypto, you kind of have to have two strategies, or two. Yeah, I would say you need a variable that tells you if you're in a bull or I don't want to say bull market or bear market, because these are last longer, but you at least have to know. And we have some, we saw at the beginning of this year a pretty bullish month in January and February. So we can call it maybe a bear market rally. But so instead of saying bear market or bull market, I would prefer to talk about a bullish rally, or a bearish price depreciation. So yeah, I think it's important the bottom line is you really have to have an understanding of cycles in crypto, and this is very, very important in my opinion. And this changes your risk appetite. This should change actually how you're trading, what you're trading, etc.
Go ahead, Tyler.
Yeah, this is a question for Corio, and I guess Mark too. He's been talking about kind of liquid staking projects the past couple months. But Corio, we talked about this narrative the first time we had one of these calls, and I know it's not like a sexy one, but is this kind of the easy, like if you had to kind of categorize one of the easiest narratives for maybe a newbie to get into, like wouldn't that be liquid staking, like Lido and Rocket Pool? And there's a lot of competitors, but I feel like this has got to be one of the like lower IQ plays that makes sense if you are looking for a long-term like sustainable narrative to invest in, I guess.
Absolutely agree with you. And by the way, this is one of the narratives that I myself am spending more time on it, because I think that it has a lot of potential and it has real fundamentals, and I think it's going to last for a long time. And so absolutely, if somebody is a beginner and they want to become a narrative trader, I think something like the LST, even if I had to say 3 names or 2 names out of all the narratives, I would say LST definitively worth watching, because it really has fundamentals. It's as we call it, it's real yield. So it's not based on some tokenomic design or some short-term catalyst or something like this. Yeah, definitely I would recommend. And also, I'm curious to hear what Mark has to say about that.
Yeah, I'm less I'm less interested in the like project tokens themselves, because like as Cryptocorio said, they are to delineate them, I would say, from the claim that Cryptocorio made, which was right, which is that the actual projects themselves are based on like real yield, and not some tokenomics gimmick or something like that. If you consider to be the token, the block rewards to be real yield, which I do. The governance tokens associated with these projects aren't as interesting to me. But the wrappers, especially the volatile ones, are extremely interesting. And I actually have I've been experimenting with a bunch of pairs, and I think I've settled on RETH and wrapped staked ETH. These are the I'm not sure if everyone will agree with me, but I consider Rocket Pool and Lido to be the market leaders. And wrapped staked ETH is the version that doesn't rebase, which is really important, by the way, if you're using any of the like DeFi infrastructure. And RETH just by design isn't rebasing, so it has the interest rate essentially accumulating to the token value itself. And if you have a look at how these assets perform against each other, they actually have quite a high volatility index, even though in general they tend to trade sideways. So in the beginning, the wrapped staked ETH and Rocket Pool ETH, they did have these kinds of like weird price differentials that I couldn't really make sense of, but that's all completely flattened out now. And so it's actually possible to trade one against the other when you see the opportunity, because what a lot of the market doesn't quite understand is that when you're trading these wrappers, you're kind of trading a futures contract in a way, because a lot of these tokens aren't redeemable immediately, or certainly not redeemable at scale. And so people are always looking for ways to get in and out of these things. Like, there's often a queue to stake, and there's certainly a queue to unstake. And so people in a rush will actually just swap it for the underlying ETH. And both RETH and wrapped staked ETH have that type of market pattern, all right, or at least that type of market behavior underpinning what's happening on the charts. And so what you can do is kind of, in a way, statistically arbitrage them against each other over very long time periods. And yeah, like I said, I've been playing around with a bunch of different pairs. And from a strictly statistical arbitrage perspective, RETH and wrapped staked ETH are a phenomenal pair to trade. It's like one of the laziest trading strategies I think I've ever developed, and I'm convinced that you could make an institutional grade product out of it. It's that predictable.
I'm glad you said institutional grade product, because that was my next question. Is this, the reason I brought it up first is I think this is an actual sustainable narrative that can be the engine possibly for the next cycle, right? What kind of applications, is there what more developments can come from this narrative, I guess? Because, the LSD-Fi ecosystem has been talked about, and I haven't seen anything that maybe I would call like a layer 2 on top of this ecosystem. So just I'd love to hear some thoughts about what else can be built into this.
The thing that makes it interesting, right, and maybe the reason I'm flirting with the concept of an institutional grade product is that what they really are interest rate products, right? And this is kind of what's been lacking from DeFi forever. A lot of projects have attempted it. we know that the Curve ecosystem, for example, still has the sort of lockup program for a relatively low but non-volatile return profile, but still struggles with evaluating or let's say correctly valuing what that what that interest rate is. Because not everyone in that ecosystem, especially the whales in it, will necessarily be able to cash out of it, as has been demonstrated over the last couple of weeks. CRV and some of these other lockup tokens do struggle and will probably struggle for a very long time with relatively thin liquidity. And so I'm not sure that institutions would be super likely to value that type of product as a low risk, steady return type of deal, whereas ETH and its LSTs maybe more so, right? Even like today, sure, like ETH is still catastrophically volatile, and it might not be here by the end of the year or something, but I do expect, especially if the ETF and the ETF and the Bitcoin ETF and things eventually get through and become more mainstream, that these the volatility that we've seen in Bitcoin and ETH, it won't last forever, right? It has to sort of bottom out somehow. And because we don't have overnight lending or anything driving driving interest to institutions this way, it actually does make sense to have something like an LST, which is something that you can hold and that is likely to make between 5 and 6% this year. Like that is something that people can do. And then when you've got different LSTs, different wrappers that all sort of represent the same sort of primitive, but where the interest rate that accumulates to them is kind of contingent on the success of the block builder, then you have then a type of interest rate swap, which is something that I remember way back in 2020 when I first joined the space, was something that I was speaking with a lot of very intelligent people about who were building protocols for it. But it essentially became a pipe dream, just because the rates of return in crypto are so difficult to normalize. But with LSTs, I think it actually could be normalized, and writing an interest rate swap might actually be on the table again. Maybe I should reach back out to these guys and see what they're doing with it, and how that plays into layer 2s and things like that. Has yet to be determined. But yeah, I'm becoming more and more enthusiastic about the liquid staking derivatives over time.
To add on what Mark said, and to come back to Tyler's question, I think there is actually a rich ecosystem of layer 2 LSTs that are being built now. And so recently I did an interview with Panelists co-founder, which you can find on my Twitter, and we discussed about that. And so we have the layer 1 LSTs like Frax, Lido, Rocket Pool, etc. that we mentioned, but now protocols are building on top of those, and they can be categorized in I would say 4 categories. So one category would be ETFs. So this is something like Index Co-op or Unch ETH, where they create a basket of different LSTs, layer 1s, in one basket, ERC20. So token that gives you diversification of these different layer 1s. So you have you can buy an ERC20 token that gives you exposure to both Rocket Pool, ETH, RETH, Staked ETH, etc., Fraxed ETH, etc. This would be one category. Then you have this CDP category, where you can actually, there are now new protocols like Raft, for example, where thanks for pinning it. That's the interview, where you can actually mint a stable coin by depositing like kind of staked ETH, and so this is another category. Another category where Pendle is the yield, different yield products. So for example, at Pendle, they tokenize yield, so you can trade the yield, because this the rates are usually dynamic and they are not stable, so you can actually trade them. This is or fixed rate yield also. This is what Pendle proposes. Yield optimization, there are different protocols on that category. And the last category are money markets, like kind of like something like Aave, where you can deposit, for example, your rocket pool and borrow some money against that. So yes, there is a lot of development actually being done on that front, I think, especially in 2023. And by the way, this is what I call LSC L2, and which is also one of the narratives that is on my narrative dashboard. And it has been one of the best performers in 2023, especially in March and April. It did pretty well. And so, yeah, I think there is development in that direction. Lastly, I just wanted to come back to the first question of Tyler and to add on what Mark said, because I thought that was really interesting. We discussed about picking a narrative, for a beginner. And so, for example, let's say that it's LSC. Now, it's one thing to say, okay, let's say that somebody wants to become LSD narrative trader, just focusing on LSCs. So what should that person do? What should that person buy, or how can that person benefit from the LSC sector? As Mark very correctly said, it's not just by buying the tokens, the native tokens of those projects. It's much more complex than that. For example, Lido, of course, is a very good protocol. It has a lot of TVL, but people are using actually Lido's products. So it's not that. So the Lido token is just for governance. The utility of the token is just governance purposes. So there is no revenue sharing. For example, Lido, the IO or the rocket pool, it's not that you're getting exposure to the LSC sector, but not in the way that you should, you might be thinking. So, and if you look at the chart of these tokens in the last year, for example, the TVL of the LSC sector has been just growing very rapidly in the last 12 months, especially after the merge, but it has not translated directly into a token appreciation, price appreciation of these tokens. However, as Mark said, you can use actually, for example, staked ETH and get your yield, etc. But it's very important that you understand actually these concepts. And then, these products, you have an expectation of, okay, how much money could I make from these, from these, because they have, for example, a yield which is between, let's say, 3 to 10%. And so this gives you an estimation of, what you can do. And so it's important to summarize. It's important when you want to, specialize in a narrative. Is it, how can you benefit from it? Is it by using their protocol? Is it by buying their token? What is then you have to really deeply understand the tokenomics and all these type of things.
I'm really glad you brought up Pendle. I totally forgot about that. How big that project has become. Does that token, is that a governance token as well, or do you get some yield from it? I haven't really looked into it, and I'll definitely take a look at the interview you conducted with TN, but just curious.
Yeah, it's not really a governance token. Actually, they have two tokens. They have the Pendle token, and then they have this VE Pendle token. So you can stake your Pendle token and then get a VE Pendle, and then depending on the maturity date, you would get a different APY. So the longer, it's similar to Curve. The longer you stake it, the higher your yield. But no, it's not really. And they also use it as the Pendle token is used as incentives, for the different pools that they have to provide you extra yield. But it's not a governance token, no.
Really quickly, you said it's a matter of what you actually do with this narrative, right? Is it buying their token? Is it participating in their ecosystem? Mark, you had mentioned trading, right? We haven't really gotten to, I want to ask you about Carbon a little bit. This automated trading is becoming quite a narrative in DeFi. There's this kind of shift from the traditional AMM sort of style to more of a really, trader focused sort of style. So maybe you can elaborate a little bit on what you were saying in terms of, and I'm going to pin something to the top as well. In terms of trading these two, you mentioned wrap staked ETH and RETH.
Right. Yeah. So I think you're right that the appeal of AMMs has kind of waned over time, and I don't think it's any great mystery as to why. I attribute their success largely to things like liquidity mining programs and other incentive programs, whatever they happen to be, that kind of made the underlying financial product look more attractive or look more popular than it actually was. Because what you were really experiencing was, people agreeing to participate in an activity that maybe they didn't understand, and they certainly wouldn't have participated were they not being incentivized with, project tokens for doing so. And so, okay, let's just acknowledge that. Maybe that's my opinion, and you might have a different view yourself. But I think that it's not controversial that that AMMs are just not as popular as they once were. With that information, I think that we, as an industry, have started to look inwards and wonder what a decentralized exchange might look like if traders were using them for their own sake, right? For its intrinsic use case, not for liquidity mining, not for artificial incentives, but because they are looking to make money from market movements, which I think is, a very helpful, very healthy direction for the industry to move in. So the way that we moved as a project was to develop Bancor. So it was to develop Carbon, which is the new order book-like protocol from Bancor. And what it allows you to do is to effectively grid trade, right? It has a very similar characteristic to grid trading bots, except for the fact that it's actually making markets, not taking them. And this has several advantages, including your price certainty, right? So whatever price you are asking for, once your order is filled, that's exactly the price that you get. Whereas when you're taking, there are uncertainties with respect to that trade that might actually impact its value, including things like front running and, more importantly, sandwich attacks, which is something that I wrote about not long ago. So with Carbon, what you can do is say, so using my RETH wrapped staked ETH trading pair as an example, which is something that I'm looking to take to Carbon pretty soon. The idea is that you have a perspective, the prices that you like, essentially. What price would you happily buy a token for in whatever numeraire you would like to use, and what would you like to sell it for? And so with these particular tokens, I can see that the price moves up and down quite a lot. But generally, it kind of moves sideways, right? It's just forming this kind of rectangle on the candlestick charts, which is nice because it means that it's fairly predictable when one of these tokens is undervalued versus the other one, and the reverse is also true, right? When one of these tokens is overvalued. And so I can very easily set ahead of time that whenever something is undervalued, according to, my rubric, please buy it. And whenever one of the other ones is overvalued, I want to sell it. But when I'm selling, I want those bids to be, or I want those asks rather, to be converted immediately into bids at my other price point. And similarly, when my bids are being taken up, I want that liquidity to be immediately converted to ask liquidity. And this means that I can trade essentially forever in one direction. The advantage with Carbon is that one, I'm making a market, so my I'm actually contributing to the liquidity ecosystem. and support infrastructure around these tokens. Whereas if you're just trading on spot, and a lot of these grid trading bots are always trading spot, you're actually kind of stressing the market, right? It can get kind of congested. And so having a little bit more liquidity there, it doesn't just give you peace of mind that you're getting the price execution that you desire, but that you are also becoming, you're actually serving an important use case in keeping the markets functioning correctly, which is valuable. So yeah, that's how Carbon works.
Mark, you said something interesting about earlier about how Curve didn't have enough liquidity. And it made me think, I don't know why, but it made me think back to when Tesla was accepting Bitcoin. And Elon had to prove to the shareholders that having this much Bitcoin was sustainable and the order books could handle a sell like that. So to prove it, he had to, I think he sold something like $100 million worth of Bitcoin in like a week in order to prove it. And it makes me think about Carbon, like, setting one, like if you were doing this for, let's call it like a low liquidity coin, like maybe not a micro cap, but a tier 2 one, you could just set that order on Carbon and let it fill indefinitely until it's out, right?
Yeah, absolutely. So yeah, you're right to kind of draw that distinction. And like, this isn't something that's even Carbon specific, by the way. And I'm sure Keith and Crypto Courier will back me up on this. That one of the biggest mistakes that I see traders making, like especially when they're getting a little bit more risk on during these manic market moves, is that they don't pay enough attention to the liquidity. Right? They get so laser focused on price that they forget to account for the fact that price is only like 50% of the calculation. That you really need to look at, how much volume moved the price in that direction, and how easy is it for people to enter and exit from positions without impacting it too much. So yeah, that demonstration, if it was $100 million, that's pretty impressive. That sounds like that definitely sounds like late 2020 to me. But yeah,
it definitely was 2020 liquidity in the order books.
Yeah,
exactly.
And we could debate whether he was actually trying to prove something to shareholders, or he was just taking profits. But I'm glad that this discussion organically went to liquidity, because as Mark was talking a few minutes ago, that was a question that I wanted to bring up. On centralized exchanges, obviously liquidity is a huge issue, and it has faded drastically here in the past year. There's times, speaking to exactly what Mark was just mentioning, where you have to calculate whether there's enough liquidity to make the trade that you want. And this is why position sizing is really important, and why a grid strategy like you're talking about is also valuable, because you're distributing your orders, your buy orders and your sell orders. You're splitting it into smaller incremental pieces, which reduce your slippage, so that you are getting the price that you want. There are times, I had mentioned the binned CVD that we have, where we're looking at the size of the order, and of course, a mega whale could disguise themselves as any smaller class order. Retail doesn't have the resources to make $3 million buys, whereas somebody with a $100 million stack could execute that in any size order. So when we see high volume TWAPing of smaller order classes, or even in areas of thin liquidity where the smaller order classes are buying in volume because the larger order classes can't do it without slippage. So, it's why one of the reasons we see so few of the big brown mega whale buys. Now, what I was going to ask you, Mark, is, with the attrition in liquidity that we've seen in centralized exchanges, and I look a lot at Binance because they are the largest and have been forever in terms of volume. Their volume dropped significantly when they took away no fee trading on Bitcoin pairs, right? That was,
let's not forget Jump's exit from the market as well.
Right. So a lot of liquidity has left the market, and much has gone to TradeFi, much has gone to hard assets and real estate. Is DeFi seeing a steady increase in liquidity, or is it not really significant enough yet for us to say that people are leaving centralized exchanges to go to DeFi in mass?
It's I can answer your question in two different ways. The first is like, yes, I'm absolutely convinced we're seeing a sharp uptick in traders coming over from centralized exchanges to do stuff on chain. This has been observed like dozens of times. I wish I could refer you to the I think it was a Glassnode report that was actually detailing this, and the quality of information matters, because I think there's a lot of bullshit reports in crypto about how many users blockchains have.
Right.
But yes, there is an uptick. It's noticeable, like above the noise, which is nice. But the liquidity problem is generic. Right, it's affecting centralized exchanges and the DEX landscape equally. So even though we're seeing more attention come onto chain, where I think that it's probably this might be the first that first wave of the demand cycle before the liquidity comes in to fulfill it. But no, we haven't actually seen it. In fact, liquidity on chain is actually still is dropping at a similar rate to what it is on centralized exchanges. Not quite as fast, but a similar trend.
Right. So we're seeing this attrition, and we're seeing and the money that is in the space, whether it's centralized or decentralized, is the same money. We're not really seeing new money come into the market yet.
Right, and that's worth exploring in a little bit more detail about like what you mean when you say it's the same money, because it hopefully is not a controversial statement to say that most of the market makers, especially during last year, were very well integrated with all of the decentralized exchange architecture, as well as their centralized exchange counterparts, as well as between centralized exchanges. It was a very sophisticated network, and what we have seen, not just with necessarily the liquidity attrition, but like I said, like some of the really big players have kind of shown themselves the door. And we have seen also like price discrepancies start to appear again between different order books, where the between exchange arbitrage is just not nearly as efficient as it was this time 2 years ago. And yeah, when we say it's the same money, what we should recognize is that when that really sophisticated, really efficient money comes in, it touches everything, right? It touches everything altogether. It's not like it was ever just on the centralized exchanges or just on chain. It was always a part of that whole like conglomerate. And I think that should give everyone, I don't want to say like pause, but it should give you sort of a better understanding of exactly how blockchains kind of interface with these systems. They're not necessarily an alternative. They're more like a backend. And that's totally reasonable, but it means that whatever we're seeing on centralized exchanges in general, we should expect, at least for the intermediate term, to see on chain in more or less the same capacity.
Interesting.
Mark,
I think this is all part of the big flush, and we're going to probably continue to see some attrition until we bottom out.
Mark, I had a question about Carbon and it's how it works. So it's very interesting because I haven't seen any other kind of DeFi solutions proposing what Carbon is proposing in terms of grids and limit orders. There are now some other protocols who are talking about decentralized limit orders, but there is also a question about how decentralized this is, etc. I want to know how this works technically speaking, because when you have so actually when I think about how a limit order would work, I guess that as a user, I would set a target price and I say, okay, I want to buy, for example, that much Bitcoin if price drops to that level. And so the way I can think about how this should work is that then you have a system which is constantly checking the price every hour, every minute, etc. And then when the price is there, then you get it will go and buy at market for the user. And this is how I think most of these systems, centralized systems, work, at least. Now, in DeFi, smart contracts cannot be automatically triggered, right? You need an external trigger to say, okay, go and buy something. So how does that work in terms of functioning?
I'm so glad you asked. Yeah, so Carbon has no oracles. It doesn't check the market price. It doesn't even know what the market price is. How Carbon works is actually much more. It has a lot more in common with eBay than it does with than any of the decentralized exchange systems that we've seen developed before Carbon. So what happens is, let's say that you've got a Bitcoin, a wrapped Bitcoin, and you are absolutely convinced that we're going to 100K, right? Maybe not this year, but at some point in the future. When you place that Bitcoin on Carbon, you just say that this Bitcoin is yours, but you have to pay me 100K for it. And there it sits, right? It doesn't actually matter what the market price is. If someone wants to buy it from you for 100K, they actually could, right? There's no prerequisite that there needs to be some aggregated price delivery system that says the price of this Bitcoin is 100K. If someone literally just wants to buy that Bitcoin from you for 100K, then by all means, they're allowed to do that.
Similarly, so in that sense, it's like an order book system where we are matching two, like one bid and one ask, right?
Yeah, correct. So we just expose all of these prices. And when a user interacts with the app, we do a lot of the, we compose the data for them so that they can see what the cheapest Bitcoin is. And you assume rational markets. And in general, I know we like to sort of mock markets for being irrational, but when we say rational, what we mean is if someone is trying to buy something, more likely than not, they're going to try and get it for the lowest possible price. And when someone is trying to sell something, more often than not, they're going to try and get the highest possible price that they can. And so that's all we do, right? Is we take that data off of the chain, we show it to the user, and we show them what the cheapest transaction is. But they can actually reject that transaction, right? If they want to, if they want to interact with a very specific position, that functionality is absolutely exposed to them. Similarly, like if you're on Amazon or something, trying to buy a PlayStation, and you sort by, lowest price first, doesn't necessarily mean that you're going to, that you are forced to buy the cheapest PlayStation. Of course you will, but if you wanted to, you could buy a more expensive PlayStation and Amazon is not going to do anything to stop you. Carbon works exactly the same. And what this means is that as a maker on Carbon, when you say I want to buy, I want to sell this thing when the market price reaches there, what you're really saying is I expect someone to buy this from me when the market price reaches there. And of course, this is just as contingent on market forces as any, right? It's not I would say that it is necessary, but not sufficient that a market price kind of gets into your range, because someone just bought something and moved the price a little way doesn't necessarily mean that there's an infinite amount of taker demand on the other side that are willing to fill your order, right? It could have been that the price moved on very little volume, and this is not unusual, not just in crypto but in any market. Sometimes prices move even though hardly anything has been bought or sold. But the assumption is that if there is good, if there's a good momentum behind whatever that price change is, then someone is going to be looking for the best possible price. And so on Carbon, we make sure that we've got that we're integrated with as many aggregators as possible, that the arbitrage network and search network on Ethereum is well aware of how to use our system and move tokens around inside it. And this means that essentially you have a very, very good confidence that if there is a true market demand to buy a token at the price that you've set, then someone is going to buy it from you. The only time where this becomes kind of marginally questionable is when you're exactly at the market price. Like, what does it even mean to be exactly at the market price? So, for example, with your 100K Bitcoin example, maybe the price of Bitcoin, on Binance, on Coinbase, on KuCoin, everywhere, gets to exactly 100K. Does that mean that we have a good chance that someone bought your Bitcoin for 100K, or a bad chance? Like, how do we even evaluate that odds? There's no good way to go about it. But let's say that all of those exchanges report the price of Bitcoin as like 100K and $10, right? Now, what are our chances? Well, probably pretty good, because even that $10, even though that $10 arbitrage opportunity is only worth $10, I've seen people take flash loans for like multi-billion-dollar trades only to extract like $1 in arbitrage value. So we basically rely on there being sufficient liquidity and market forces moving stuff around that would cause the market to find your order and then take it. And so from our perspective, market arbitrage in this case is very, very positive, right? Makers are wanting to get their orders filled, and so we make sure that they have the highest possible confidence by doing things like, building an arbitrage bot and giving it away. Right, we have, I think, the only open source arbitrage bot on Ethereum. I'm not sure if that's true, but I think it's true. And we teach people to use it. It's like, yeah, if you want to to learn how to become an arbitrager and keep prices well equilibrated across the entire ecosystem, then here are the tools that you need to do it. And in doing so, that will actually mean that the makers on Carbon get more and more confidence over time that their orders will be filled, even if their tokens are extremely exotic.
That's very interesting as a trader, because you've probably seen, and I think Keith has talked about that. There is one of the things that traders do is to look at the limit orders of other traders. And then there is these indicators that say, okay, there is a sell wall here at that price, and there is a buy wall here, and so it might attract actual liquidity there, etc. And until now, it hasn't been possible to do these things on chain, because most of the orders are market buy orders or market sell. But now with Carbon, especially me as an on-chain analyst, I could go ahead and, for example, develop a Dune dashboard, which would go and check the limit prices people have placed on Carbon for Bitcoin, for example, and then I could myself reproduce these walls and say, okay, most people are expecting a price around, let's say, just random numbers, 26K, because I see a lot of limit orders on Carbon of buy limit orders, right?
Yeah, correct. It gives you a much better insight into like the market's personality and mood, right? I think one of the things that AMMs have always obscured is like, yeah, sure, you can recreate an order book from it in like a technical sense, right? In the mathematical sense, you can draw a depth chart and whatever you want, but because of the passive nature of it, or the total lack of agency of the liquidity providers who are there, and even the complexity of their decision making or lack thereof, means that you don't really know what that order book structure means, if anything. Whereas on Carbon, when you're looking at it, like someone actually chose that price, right? They put that liquidity there. That's information. And yeah, absolutely, you can do it. And you can create a June dashboard, not just for the current liquidity, but also historical liquidity, and compare that to price action. And it would be like, this is exactly the kind of thing that Keith's fire charts does, right? It correlates historical liquidity patterns with price movements. So it is useful information. And I think that one of the things that I've said is that I think it gives markets confidence, right? When you can actually see what decisions people are making, and that it fosters more engagement and I think in the long term better decision making. So yes, absolutely, you could write a June dashboard and SQL query to pull that data out.
Okay, I think I found the idea for my next dashboard then.
I love that. We didn't even get to talk about your ecosystem dashboard, and we have like 5 minutes left. We went over 8. But I know Keith is unmuted, so I want to give him a chance to speak. I have been throughout this discussion pinning things to the top. So a couple of the things that Corio was asking about that Mark was referencing, in terms of how the trades actually occur, the Fastlane arbitrage bot, which by the way, I am not technical at all. I have never run an arbitrage bot. Never mind, really been close to it. I am now running the arbitrage bot myself. So this is not something that is out of your, like Mark said, we're walking people through it. If you want to know more, I did pin the Telegram link to join the Carbon Telegram, along with Keith. I saw that you tweeted the link to join the material indicators community, so I pinned that to the top. But
Awesome.
I definitely encourage everyone of Dune dashboards. Carbon has the Dune dashboard. There are strategies on there. You can see where everyone has their ranges and things like we were just speaking about. But Corio, I'm a fan of your dashboard, so I'm not going to discourage you whatsoever from creating one of your own that could maybe be, ecosystem wide. But Keith, go ahead.
Well, I'm not going to take up more valuable time on this. I had a question about liquidity as Mark was explaining it, and he pretty much covered it. So I'll just let it lie there, and we can keep it moving forward, so we don't keep running long.
Okay, well, with that though, does anybody else have anything that they would like to add? Like I said, I didn't get to speak to Corio's new ecosystem dashboard. We were speaking about ecosystems earlier with the LST narrative. So I definitely want to encourage everybody to join the communities, check out the Dune dashboards. We've spoken about tools in the past and how valuable they are. So yeah, I mean, I don't want to just let that slide by. Corio, I think that's your new pinned tweet. Am I correct in saying that?
Yeah, exactly, yes.
Okay. Perfect. Okay, any last thoughts, guys?
I just love this panel. You guys are awesome. Jen, thanks for finding everybody and putting this together. It's just my favorite talk of the week.
For anyone who hasn't had a look at Keith's fire charts, I strongly recommend it. I've done I spend a lot of time looking at like trading signals stuff, and it's usually like a black box, where it's not entirely clear exactly what analysis it's performing. And, sometimes you can kind of, dig around in the source code if it's available. And often you end up sort of disappointed with the sort of the uninspiring nature of exactly what's being performed. No better than chance, I'd say, is most of the, is kind of par for the course. But yeah, what really sort of struck me about the stuff that you see in the fire charts is that it's actually like a liquidity first indication, and that's a profound difference compared to what you'll get in most trading indicators that rely entirely on price or price velocity. This one is I think pretty special in the fact that it actually uses liquidity itself as like the primary indication of what the market is doing, and that's it's very rare.
Hey, thanks for that. Thanks for that, Mark. I really appreciate that. And I will just add to that there are a lot of data visualization tools out there, and there are a lot of order book maps out there. What where I get the most value out of this is, here's what I found. Oh, Siri's going to tell me now. Where I see so much value in between just the at a glance look at where resistance and support are sitting is, and especially on the newer version of Firecharts 2.0, which has higher resolution and longer history of heat maps, is to see and pretty much real time where liquidity is moving, because we could be sitting there chopping. And how did I know that we were going to bounce yesterday? Because I saw the liquidity percolating underneath, and I saw it fading from the top. And so when you can identify what you're looking at, and you can see where the momentum is coming from, you can trade it.
Amazing. Keith, thank you, Tyler. Thank you, Crypto Choreo. You guys are fantastic. I genuinely love this call. I hope all of our listeners do also, and they took some valuable information from this. I'm actually going to follow this up with all of the links that I did pin to the top. So if anybody is listening to the recording, hopefully they will see all of those pinned tweets as well and have access to all of the same information and reference that just the same way that we are. So thank you guys so much. We will be back next Tuesday at 4 p.m. UTC. And I look forward to hearing from all of you again.